CFI The Complete Guide to Trading. Basic trading concept. Random walk theory. Before you decide if you want to be a trader, you have to first decide whether or not it's even responsible to believe that trading this can be a profitable endeavor. In order to make that call, you have to choose which basic market theory you believe. A random walk is a statistical phenomena where a variable follows no discernible trend and moves seemingly at random. The random walk theory has applied to trading most clearly laid out by Burton Mikhail, an economics professor at Princeton University, posits that the price of securities moves randomly, hence the name of the theory, and that therefore any attempt to predict future price movement through either fundamental or technical analysis is futile. The implication for traders is that it is impossible to outperform the overall market average other than by sheer chance. Those who subscribe to the random walk theory recommend using a buy and hold strategy, investing in a selection of stocks that represent the overall market, for example, an index mutual fund or ETF. Basic assumption of random walk theory. First, the random walk theory assumes the price of each stock follows a random walk. The random walk theory also assumes that the movement in the price of one security is independent of price movement in another security. One of the main criticisms of a random walk theory is that the stock market consists of a large number of investors, and the amount of time each investor spends in the market is different. Thus, it is impossible for trend to emerge in the price of securities in the short run, and a savvy investor can outperform the market by strategically buying stocks when the prices is low and selling stocks when the prices is high within a short time span. Other critics argue that the entire basis of a random walk theory is followed, and the stocks prices do follow patterns or trends even over the long run. They argue that because the price of a security is affected by an extremely large number of factors, it may be impossible to find out the patterns or trend followed by the price of that security. But just because a pattern cannot be found does not mean that a pattern does not exist. A non-random walk, in contrast to the random walk theory, is the continuation of believers in technical analysis. Those who think that future price movement can be predicted based on trends, patterns, and historical price action. The implication arising from this point of view is that traders with superior market analysis and trading skill can significantly outperform and the overall market average. Both sides can present evidence to support their positions.